Hello members and welcome to the Fat Profits Macro webinar. Thanks for your company today. My name is Roger. I'm your host for the webinar, and joining us today is our founder, our CEO and fund manager, Angus Geddes. Angus, welcome to today's webinar. How are you?
Yeah, good. Thanks, Roger. Always good to be here on the webinar.
Great. Yeah, lots to talk about today. A few things happened in US and Australia over the last week. So before we get into it and get your insights, our disclaimer, all our presentations are general information. We don't provide any personal advice. If you're looking for that, please see your financial advisor. And also past performance is no indicator of future performance. Now, towards the end of today's webinar, if you're new to our membership, we've got a Q&A session. You can ask some questions about the macro, about the markets. Keeping in mind, this is not a stock-specific webinar. So for stocks, we have a Monday webinar with our research team. So feel free to talk about stocks on Monday. And let's get into it. So first thing first, quick look at the topics we will discuss today. So we're going to have a look at the US inflation figures to come out last night. Australia and China striking a deal which could be quite beneficial for our economy. IMF lowering the growth forecast for the globe. Household savings, this will be quite an important one. Banks tightening credit, how that's going to affect the markets. Oil, US dollar, and the all-important inverted bond yield curve, how that's looking today. We'll look at the US earnings seasons that are about to start, and of course, charts for ASX and S&P. Now, first thing is quick look at the global markets for the last week. You can see NASDAQ is the only index which is down from last week, and we did talk about it in detail, how that's looking quite overpriced at the moment. But you look at the ASX, quite good performance in the last week, up around 1.5%. FTSE chugging along, and the Asian market is also not too bad. Now, first, let's talk about Australia today. Now, for some of you may have heard the news that the federal government pretty much reached a deal with China to resolve the dispute that started 2020, and this is around barley. Now, Angus, I'd like to hear your thoughts on this, because this is, of course, good news for Australian exporters, but this could spill over into other sectors of the market, including beef, coal, as well as wine. So what are your thoughts on this progress?
Well, I think, it really sort of points to the fact that, China is reliant on importing quite a big chunk of its food. It's in terms of the food that it consumes. There's obviously a food security issue in China, and I think essentially they've agreed to start importing Australian barley. Beef will probably be next, and maybe wine, simply because they need those products. And maybe also politically, they want to get things sort of back on an even keel with the Australian government. That might have a bit to do with it as well. But clearly, they need these products that Australia makes, so and produces. So it doesn't really surprise me.
Yeah, look, there is a need, you're right, and I think this will be very good news once this all behind us, because the new government certainly has made some inroads into the relationship, rebuilding it, and this could spill over into other parts of our economy. And we've seen some of the stocks move up. For example, Treasury Wines, that's one stock which could also benefit from this. So time will tell. We'll keep an eye on that. But also moving on to what our inflation conversation, Jim Chalmers recently talked about the fact that inflation could be around for longer than expected. And the RBA is now forecasting that inflation in Australia will decline to 4.75% by the end of this year, before easing to around 3% by mid next year, currently sitting at 7.3%. So how do you feel about inflation in Australia?
Well, first of all, what I will say about forecasting is, as we all know, forecasting is an inherently difficult exercise. And, the further you go out, i.e. to 2025, they're calling 3% inflation by 2025 and 4.75% by the end of the year. I mean, there's a lot of variables. And in terms of inflation, well, I think, we all know that it's going down. That's not the issue. The issue is how fast is it going down? And, as we saw in the US overnight, the core CPI didn't really change much. The headline CPI is trending down. But of course, lower energy prices, lower gas prices at the pump were responsible for a big chunk of that. So, I just keep focusing on the oil price. And, as we know, the oil price broke out to the upside this week. It almost looks like energy has inflected to the top side. Yes. So, if it does go back to $90, $100 a barrel, well, the inflationary impulse that kicked the whole cycle off a year ago is back. So anyway, look, it's early days yet. We haven't seen oil push through $90 to $100 a barrel yet, but it's worth keeping an eye on, as are some of the other commodities. It's quite sort of pertinent this week that I think that the gold and silver have broken out, and we'll probably talk a bit more about that later in the webinar, Rog.
Yeah, absolutely, Angus. Very good point about oil, but you're right. Forecasters often get it wrong, and look, even if they get it right, that still means the cash rate will remain high for longer. But looking at the overnight news in the US inflation figures, so there's some good and bad news. I suppose the headline inflation, which is what you're looking at now, has come down to 5%. So that probably from a headline perspective is certainly good news. The highest it has been is 9.1% last year. So the progress is reasonably good. However, 5% is still high. But the bad news is that the core inflation, which is the preferred measure for the Federal Reserve, that's ticked up to 5.6%, and that excludes the food and energy component. So how do you feel about this one, Angus? Because it's still pretty sticky around that.
I think it's problematic. Because, we've got this inflation that is not going down at a great rate of knots. Yes, it's come down from the peak, but we're still a long way from target. Ultimately, that means that the central bank's going to have to keep interest rates high for longer. The longer they keep the interest rates up, the more transmission impact there is to the underlying economy, the greater risk of a recession. It's as simple as that. Now, the bond market is pricing in interest rate cuts to begin in July. And, the stock market is making the assumption that earnings are just going to keep growing. So, maybe both of those assumptions could be quite wrong, particularly if this inflation remains high and the central banks don't cut interest rates and keep interest rates high, until such time as the US or the global economy enters a recession. So I think it's a problem.
Yes, well, certainly it is a problem that needs to be tackled. And look, it looks like the Fed might have to just raise rates one more time. But looking at the non-farm payrolls, which we discussed last week on Thursday, that came out on Friday, it's come down to 236,000 jobs. So on a headline level, it is slowing down, pretty much in line with expectations. So nothing really moved the needle too much there. But let's move on to IMF, which also a couple of days ago have lowered the forecast for global growth. and especially in the US, which is now forecasted to be growing at 1.6% for this year. But the global growth is now expected 2.8%, so that's been ticked lower. And they did refer the banking crisis as well, that could certainly impact, the recession probability. So how do you feel about that?
Look, I think the IMF global growth forecasts are quite ambitious, Roger. It's assuming that inflation falls pretty quickly, that central banks probably start cutting interest rates, that inflation is going to remain benign in the developing world. So I think it's quite ambitious. I think if anything, there are risks to those forecasts. As I sort of mentioned before, if the central banks are forced into having to hold interest rates higher for longer, and it's certainly looking that way with the inflation data that keeps coming through. We haven't seen a lot of inflation in China and the developing world, which does give them a bit more scope. And we can expect China to grow, but I mean, again, I don't think China's going back to the heady days of 9 or 10%. I think they're going to be in for lower growth after the rebound from the reopening washes through. So, look, my take is those forecasts are fairly ambitious.
Yeah, you're right, and they've lowered that a couple of times. But moving on to the minutes of the meeting, came out yesterday, Federal Reserve previous meeting, and it indicated that they expected this banking crisis now to cause a recession this year. In fact, that's part of the minutes of the meeting. So for some, it probably won't be a surprise because the market is looking at that. And one of the key indicators is the inverted bond yield curve. And we can see that from history, that every time this yield curve has gone past that 50% mark, which is the red line, and we've seen a recession a few months after, and that's the gray bar, which is the recession. And we can see that there now, that is quite heavily inverted, and we can expect a recession. Even the Federal Reserve is now looking at that, Angus. So your thoughts?
Yeah, look, I mean, we've been saying there's going to be a recession for a while, Rog. The Fed are now saying there's going to be a recession. That's the first time they've sort of come to that conclusion. And I think, I think the stock market is also anticipating a recession, but a mild, shallow recession. So no one's sort of anticipating a hard landing yet, just a shallow, short recession. My view is that with what happened with the banking crisis last month, we're going into a credit crunch. Money's going to be harder and harder to borrow, more expensive, obviously, but harder to borrow. And this is going to cause quite a sharp slowdown in the economy later this year. And I think the chances are that we potentially have a deeper recession than perhaps what the Fed are anticipating at the moment. Given a looming credit crunch, and also given the fact that inflation is not yet back in the bottle, which may constrain the central banks in terms of cutting interest rates. They might not be able to do it as early as probably what the bond market is pricing in at the moment. So yeah, I think the odds are we have a deeper recession, and regardless of whether we have a recession or not, I'm still of the view that US equities in particular are too expensively valued. They're not reflective of the downside risk to earnings. And where the economy slowing down is half the story, I think it's also about the overjuicing of the economy and the post-pandemic years. I think a big part of the the downward revision in earnings story is also comes back to the fact that the economy has to right itself from those, those big consumer spending years. We've yet to see. We saw positive operating leverage. I think now we're going to see negative operating leverage. As the consumer comes off that sort of sugar high.
Yeah, absolutely. Worth noting as well, when the yield curve really starts to come back down, that's when really it takes a few months, and a few months after that is when the recession has hit. This is historical, and now it's starting to make its way down, but it'll probably still take some time before it really starts to go back. Now, the other thing which you might not be able to see very clearly on this one, so we apologize, but just a brief note on the household savings. And this is a recent survey, only came out a couple of days ago. 53% of Americans say they don't have emergency savings, quite alarming, because only about a year ago, this was actually quite the reverse. The household savings rate was at a record level, and they've been drying up pretty quickly. And in this particular chart, it shows that only 38% of Americans have more than $20,000 in savings, and the remaining have less than $20,000 in savings. So that's a bit of a concern leading up to higher rates, because a lot of people are now borrowing money on credit cards and other loans. Now, the next thing to look at, Angus, is the earnings season for Q1 in the US is now kicking off tomorrow. 87% of the S&P 500 companies will be reporting by 5th of May, which is only about 3 weeks away. So a lot of reporting happening. The expectation from the markets is a decline on earnings of 6.8% year on year, which is going to be a bigger decline, or the biggest decline in the last 2 years. Your thoughts? The banks are the first one to report tomorrow. Your thoughts on the upcoming reporting season and possibly even the banking sector?
Yeah, if you can put that previous slide up.
Sure.
Look, I think we're right on the cusp at the beginning of the downgrade cycle that we've been sort of flagging to our members, since the beginning of the year, really. Before we sort of went into this quarter, the market was looking for a small amount of earnings growth. It's now looking for a 6.8% decline. I still think that's too low. I think it's going to be a bigger decline than that. Probably more in the vicinity of probably 10 to 20%. And I don't think that's in the price in terms of the S&P 500 valuation. Now, just on the S&P 500, we should probably also talk about the rally. It's been driven by a small group of companies. So about 90% of the outperformance in the S&P 500 has been driven by 25 stocks or less. 5 or 6 companies make up 25% of the index. So, risk has become quite concentrated amongst a handful of companies as it relates to the index at the headline level. Beneath the surface, we're seeing a lot more damage to companies reflecting those earnings downgrades coming through. So, I think it's just really a matter of time before the penny drops for some of these larger companies that have been driving the S&P 500 rally. So I'm a bit wary of, the likes of Amazon, Apple, Alphabet, companies that are actually quite sensitive and leveraged to the consumer.
Yep, absolutely. So it'll be interesting to note how the banks report tomorrow. So keep an eye on that, and we'll certainly report back in due course. But the key thing now that a lot of focus is turned into, including the Fed and a lot of economists, is the credit tightening following the recent events of the domestic banks. And this is quite an interesting looking chart, because this shows that when the domestic banks really start to tighten their lending, again, this has been followed by a recession. And this is now, we're looking at closer to the 40% mark. So from 1990, when the tightening went up to 40%, and 2000, 2008, 2020. And now we back just bang on that 40% mark, and probably just early days. This might just tickle over. And this is probably another key indicator which might not help the growth of the economy. So that's something to keep an eye on.
I think that's a good point, Rog. I'll just say that, the fact that the Fed managed to avert a crisis in the, within the regional banks by, making sure liquidity was abundantly available. Look, that's all well and good, and I don't think we're going to have a meltdown in the financial sector like we had back in 2008. I really don't. But we could have a credit crunch, and the banks that are taking advantage of that liquidity, just like they did in 2008, they're not going to be that willing to lend that money and put that money back to work in the economy. So, a credit crunch is very much on the cards. And of course, credit crunches typically coincide with recessions.
Yes, absolutely. Very good. All right, let's move on to the ASX and the S&P 500 and give our projections. So, Angus, this is always a tough one because nobody knows exactly where the index is going, but for sure it's going in a sideways direction. Hasn't been really a clear winner so far this year, up and down. How do you see the impact of the upcoming, earnings season and otherwise? How do you see the ASX being affected, and where do you see that over the coming months?
Look, I still think there's some downside risk with the ASX, but as we've sort of been saying, I don't think a drawdown in the US would see a drawdown of the same magnitude in the Australian market, simply because our valuation is lower. Plus, we've got a lot of valuation support from the resources sector, and we're getting earnings growth coming through, in that area of the market. So. But, I'm still cautious. I think if you do get a drawdown coming into or coming out of, coming out of the, coming off the back of the March reporting quarter in the US, it's hard to see how we wouldn't have downward pressure in our market. But I do think, there's significant valuation support at 6,400. And, it has been encouraging that we've bounced off that 7,000 level this, in the last couple of weeks. But it remains to be seen whether we can break through topside resistance at 7,600 and race away to make new highs. I don't think that's on the cards. And, I still favour remaining defensive, picking your sectors. We obviously like the precious metals and gold at the moment, and keeping plenty of cash and waiting for the opportunities.
Yeah, absolutely. All right, looking at the S&P 500, we've stuck around that 4,100 points. Now, we've made some calls on this in the past, but do you see that going down by about 15 to 20% over the coming months?
Well, this is quite a constructive, technically, bullish pattern that we're looking at in terms of the S&P 500. So on the surface, you'd look at that and you'd go, well, that's pretty bullish, and we could get a topside break. And for all I know, Roger, we might get a topside breakout. But what I can tell you is the rally is being driven by a handful of stocks. It's not a broad-based breakout of companies across the board. Most stocks and the S&P 500 are actually deteriorating beneath the surface, and we're seeing the rally concentrated in the hands of just a few companies. So this is hardly the stuff of new bull markets. So, I remain cautious, and I think, we've got the reporting season coming up. The bar's being obviously lowered going into reporting season, which, sets companies up to, come in with better than expected results. But again, it's going to be all about the earnings outlook for the next 12 months. Wall Street's lowered it by 6.4%. I still think there's more to go in terms of those downward revisions. I think it's going to be in the vicinity of possibly, 10 to 20%, as much as 20%. So, still remaining cautious. But at a headline level, the S&P 500, it seems to be climbing a wall of worry. And for all I know, it could break out above that 4,200 level, and which we might see a lot of short covering and hedges taken off, etc., which might push the market even higher. But the quality of the rally is just not there.
Yeah,
It's a low quality rally that's driving it. Typically in a new bull market, you get breadth, you get small caps, mid caps, tech, cyclicals, everything breaking out across the board. We're just not seeing that at the moment.
Yeah, 100%. So keeping in mind, we're not suggesting to sell everything as well. So that's just bear that in mind. But for those of you who have acted in the past and raised some cash levels, we're supporting staying with that cash and having some patience. We do think the buying opportunities will arrive over the coming months. So it's not all doom and gloom, but good quality companies are holding up pretty well. However, there will be some better opportunities in our views, so just bear that in mind. Okay, well, let's move on to the final couple of topics. The US dollar, now it's resting on some support around 101. How do you see the greenback, Angus?
Look, it hasn't broken that support level, but it's worth keeping a very close eye on. And it's something that I'm watching closely. The US dollar holds the key to so many different sectors within the financial markets. It drives flows between the developed world and the developing world. It moves emerging markets. It influences commodities. It influences precious metals. So I'm watching it closely, and the price action has been pretty sluggish. It's looking quite lethargic, and a break of that big support level could mark the next downward leg in the US dollar.
Yeah.
And I think that would have pretty significant implications for commodities, energy, oil, precious metals, gold, inflation, and also emerging markets. So it's worth us keeping a close eye on it.
Yeah, Jim just asked a question earlier about saying what events might be expected to trigger a reversal upwards in the US dollar. What could?
Sorry, what was that again, Roger?
He's saying what events might be expected to trigger a reversal upwards in the US dollar? What could push it up? Yeah.
Well, let's say, central banks start cutting rates around the world. The US keeps their rates high or puts their rates up even higher.
Yep.
The interest rate differentials start widening between the US and the rest of the world. That would have a bullish impact on the greenback. But, that's a pretty big call. So, if anything, I think interest rate differentials between the rest of the world and the US are going to narrow. And I think growth prospects and growth outlooks are probably also going to come down a bit. And, we've got we've had underperforming stock markets in Europe, UK and Asia for, much of the past several years. That performance is beginning to turn around now and being challenged and challenging the US. The US stock market has outperformed for the last decade, and so we might see a reversal there, and that always impacts capital flows.
Yep. Okay, thank you. And the last topic for today, before we take some questions, is oil. And you've touched on that earlier already, but oil has broken past the $80 a barrel, and now it's about 83. And we know what's going on with OPEC cutting down production, and that's certainly not going to help the inflation issue over the next month or so. How do you see oil? Do you see that now going further north?
I think this is the most significant chart that we've talked about today, Rog. And the breakout in oil above that big resistance level is pretty significant. If you read through the Fed minutes, the references about, and if you look at the inflation data that came out of the US this week, I mean, everything was referencing lower gasoline prices as being one of the major contributors to the lower CPI. So this chart is telling us a different story. It's telling us that oil's now breaking out on the upside and it's inflecting higher. So, if it goes back to 90, $100 a barrel or even higher, like it did in 21, the inflationary impulse is back, and the falling inflation narrative is in trouble. So, I think this is really worth closely watching. And, as we know, and as I've been writing, that the United States is not the swing producer that it once was. It can't just crank up supply out of the shale industry. The capital's just not there, and in this cycle, and probably won't be there unless we saw, oil well north of $100. So, it puts OPEC in the box seat, and they seem fairly committed to restricting production and getting prices up. So this is the chart that we want to be watching. This holds the key to where inflation's going to go, I think, looking out, over the next 6 to 12 months. And it gives us a big clue into what the central banks are going to do on the interest rate front.
Yeah, very good point. Okay. All right, we'll take some questions now. So the first question is from Richard, saying, hi, Angus. Do you still think it's good to stay out of the market, particularly as the traditional downtime in May, etc.?
Yeah, so we're holding 25%, 20 to 30% cash in our model portfolio. So we're not out of the market. We're just holding more cash than we otherwise normally would. We've also upped our allocation to precious metals within our models, and with the view that sector is going to do quite well this year. We're still positioned defensively. As I said before on the webinar, I think the rally in the S&P 500 at the headline level lacks quality. I think it's a low quality rally. And we've seen, I think we're on the cusp of an earnings downgrade cycle, which has already begun. The market's pricing in a 6.8% drop, but I think it's going to be a lot more than that. So, yeah, we're still cautious.
Very good. Next question regarding Australian bonds. This is from Joe, saying, when do you see it'll be time to buy Aussie bonds in my super fund and US treasuries like TLT in the US?
Yeah, that's a good question. I mean, we've had this big rally in long duration bonds. So, I'm a bit gun shy. I wouldn't be rushing out to buy them today, particularly if inflation improves difficult to get back to 2%. It means that the Fed are going to keep raising rates, or they're going to keep rates higher for longer. And as we talked about before, what happens if oil goes back to $100 and $100 a barrel, and the inflationary impulse comes back? I mean, that's kryptonite for bonds. Right now there's a big assumption in the bond market that we're going to be in recession by the end of the year, and I think that's a fair one. I think that's a fair assumption. But there's also a big assumption in the bond market that the central banks are going to be cutting rates by the end of the year. Certainly, if we look at the Fed funds futures markets in the US, pricing in rate cuts as early as July. I just don't think that's going to happen. Not when inflation is this high.
Yeah.
So yes, to answer that question, I wouldn't be rushing out to buy long duration bonds today. I think they've rallied. They've had some big gains in the last month or so. I think the low hanging fruit in the bond market has been harvested.
Yep. Good answer. Thanks, Angus. Next question regarding Russell 2000. So Jeffrey's saying, Angus, could you please comment on the Russell 2000 index? What are your thoughts there?
Well, you know, the Russell 2000, if we look at the technical price action on that index, it's quite different to the S&P 500. You know, a lot of small mid-cap companies are doing it a lot tougher than the 5 or 6 companies that make up 25% of the S&P 500. You know, small cap land, it's struggle street. But, you know, as we all know, you know, when small mid-caps are doing badly, it means that the economy is doing badly. And I think it's only a matter of time before the S&P 500 reflects what's going on at the small mid-cap end of the market. That's my view. You know, the Dow Jones price action, again, you know, there's a lot of cyclical stocks in the Dow Jones Industrials, you know, and that index has not been doing as well. So, yeah, I think it sounds a note of caution.
Yeah. All right, excellent. Thank you, Angus. We've got some comments come through from a couple of members saying, Giri just mentioned Angus's analysis is so clear and perspective, so that's great. Thank you. Another member said, very good to hear clear thoughts and direction on where the markets and commodities are going. So look, appreciate the feedback. And now what we'll do is also just quickly announce, so some of you probably already know this from the emails today and yesterday, that the research team and Angus are going on a publishing break next week. So next week there won't be any daily emails or any communication or webinars. So we just take a break and then we will come back all over again, refreshed and recharged. So tomorrow, I think, Angus, you're traveling, so there won't be any daily email tomorrow and next week. Is that right? And also wish you a good break.
Thanks, Rod. Yeah, no, we do need these breaks to recharge the batteries. We typically have always taken the week off after Easter. It didn't quite work out this year, so we're taking next week instead, and we'll be back publishing I'll be back on the 24th of April. If something like you know, if there's a major event in the markets while I'm away, of course I will provide an update to members. It'll be probably a short format update, and but you know, the markets are at a fairly interesting stage at the moment. But you know, aside from that, yeah, we'll be back on the 24th.
Yeah. All right. Excellent. We wish you all the best, Angus. Thank you for your time today. Also, members, all the best. We will catch you again in, well, just over a week. So enjoy the break and wish you the best in the markets. My name's Roger. Thanks for your time, and we'll catch you again.